I think we will get going now, guys. As ladies and gentlemen, as people join, we'll just admit them to the meeting. But we are recording the session, so for those who join a bit late, I'm sure they'll be able to catch up. So, firstly, welcome everybody, and today we welcome two of our members from the chamber to the panel discussion on the impact of COVID-19 in the real estate industry. Looking forward to an action-packed event with some really good information coming through. Jason and Stef essentially are both going to offer some key insights to the current and future state of the property investment, as well as the effects and remedies on the commercial rental market, as well as giving us a view of what the future looks like for commercial real estate. Welcome, guys. Stef, probably starting with you. I wonder if you could just introduce yourself to the community, give us some of your background as well as your speciality.
Yeah, sure. Thanks a lot, Nigel, and kind enough of you to include a picture of myself with a pre-COVID haircut there. So I appreciate that. Yeah, look, for the South Africans on the call, I'm born and bred in South Africa. I grew up in a town called Savills that you may be familiar with in the Vaal Triangle, just south of the Gauteng Free State border there. I've been in Singapore, the last 3 years, and in Asia since 2009. After living in the USA and doing some postgraduate studies in the USA for a little while. So a real pleasure to be here, and thank you very much for having me. A very exciting topic with really a lot going on at the moment. And then I think I'll just quickly talk, seeing as some, particularly those that are dialing in from South Africa, may be unfamiliar with Savills. I'll just quickly touch on what we do. But in short, we're a real estate advisory firm. We don't invest ourselves, although we have a big and highly competent investment advisory firm. We don't invest ourselves in order to remove any kind of conflict of interest when we advise tenants. We employ about 40,000 people across the world. The majority of those are actually based in Asia, although we are a London headquartered firm. Again, just to kind of bring it home for those that are based in South Africa who may be unfamiliar with the brand, we are in Sub-Saharan Africa affiliated with Pam Golding. So I think any signage board, even residential signage, if you look closely on a Pam Golding signage, you'll see our logo, the bright yellow one, usually in the sort of top right corner there. That's our Sub-Saharan African affiliate, although at this stage we don't have any owned offices there, but certainly a strong presence through Pam Golding.
Thanks, Stef. It's always good to hear that regardless how long you've been out the country, you still maintain that South African accent. It's always easy to hear. On to Jason, and Jason, thanks for joining us. I wonder if you could just introduce yourself and your background in the industry.
Thanks, Nigel, and thanks, Stef. A great opportunity to work with you on this webinar, and to the audience for taking the time out to join us today. Looking forward to an interactive webinar. So, just in short, born and bred Johannesburg, educated in construction at Wits University. Worked a bit in construction, then moved to Absa Bank, spent bulk of my career there in 15 years in commercial real estate finance, and then a little bit in private banking. 5 years ago, I left South Africa on international assignment, with 2 years in Kiev, Ukraine, and then now I've been 3 years based in Singapore, and working for IP Investment Management and responsible for capital raising and managing investor relations. IP Investment Management, on the next slide, just a quick overview. We're a private equity real estate investment company that sources, invests, and manages direct institutional properties on behalf of its clients. We have 2 offices, one in Hong Kong and Singapore, where we hold an SFC and Monetary Authority of Singapore license, respectively. We've done 24 investments to date, bulk of them in purpose-built student accommodation. And yeah, we currently, that equates to about 552 million of US dollars.
Cool. Guys, I've known you for about a year now, and it's great to see what you guys have been doing in Singapore. Just probably my first question to you would be, you know, with the event of COVID-19, is it the time for real estate now?
Yeah, I think it's a very you know, good question, and a common question that's come into to the top of mind at the moment. I think real estate is a safe haven. It's always an attraction for investors, and I think you know, despite COVID, and I'll touch on it a little bit on COVID towards the question, but I think despite COVID, I think it's always good to look back and understand real estate and why real estate and why it's such a great asset. And I think the first thing is that it's a tangible asset. It's something that we can touch and feel. We're all in it right now. It's bricks and mortar, and I think for me, I think that's a fundamental you know, aspect of real estate. It holds intrinsic value through its actual structure and even its fixtures and features. So it's a long-term investment. Stable income is generated, which effectively, you know, being long-term, it holds its appreciation, its capital appreciation. It's not as volatile as some of the other asset classes. So the illiquid nature actually protects the capital value behind it. It's one of the easiest assets that you can raise debt against, you know, and typically your cost of finance against real estate is lower than some of the other asset classes. Asset managers on the call are out there, you know, then they always add in real estate to an investor's portfolio. You know, it adds balance and diversification. So while you may be exposed to other more volatile markets, real estate adds that diversification and balance. It also is used as legacy planning or retirement planning. You know, a lot of investors invest into real estate to pay off the debt over a number of years, and then sit with a unencumbered asset that's generating rental income that is supporting your retirement. And you know, a lot of investors pass their wealth through real estate onto their children. And there are three highlighted grey kind of bullets there. You know, real estate offers exposure into different currencies. It's you know, so if you're investing out of Rand for South Africans, or if you're primarily in US dollar, you know, buying a property in the UK, you know, gives you exposure to the pound. You know, also if you're exposed economic and it creates economic and political exposure. So again, if you're South African and you want exposure in the UK, you know, real estate is another avenue that you can access exposure to different markets. And I think capture opportunities. I think given now where we are with COVID, I think this is now where there may be opportunities presenting themselves. So you know, you may see some softening in the market and therefore opportunity to enter real estate, which you maybe not have had access to. So taking these fundamentals into place, and I think given the current circumstances of COVID, these fundamentals shine through either post or pre-COVID, in the COVID, and post-COVID. You know, actually COVID highlights the strength of real estate and the fact that it generally holds value and it doesn't react as quickly to some of the other asset classes. There's always a lag effect with the value of property, and I think that you know, that highlights the strength of this. And there could be, you know, I think there'll be a flight to real estate in the short term, you know, during this unprecedented time.
Cool. No, I mean, good point. And I mean, I think even as a property owner myself, I think you know, the propensity to hold on to that property through the bad times has proven to result in a benefit for me, even as a small property investor. So thanks for that, Jace. Stef, you know, being a business owner in South Africa and Singapore, owning businesses in both those territories, we've also been affected, and I'm sure a lot of our community in the room today have also been affected with COVID-19. What are my entitlements? What reliefs should I be pursuing? You know, we went on quite a run to try and reduce cost, and obviously the big cost is always, you know, what is my rent hold? Maybe you can offer some insights into where we should go from here.
Yeah, thanks, Nigel. I think, you know, you're not alone in in sort of asking those questions and wondering, you know, the big question at the moment, or really starting last month here in Singapore, should I be paying rent, right? I can't access my office. You know, my business has been impacted very heavily. You know, should I be paying rent? Maybe I can't afford it. And I think if I could just take a step back, and I think really, you know, any kind of rent discounts or rent relief, we need to sort of place them in different buckets as appropriate. So you can see here I've tried to capture 3 different opportunities for rent reductions or rent discounts to make sure you understand each as a separate opportunity. The first one is for those companies that find themselves, you know, where their businesses have truly been impacted by COVID-19. You know, their revenues and profits are down materially. You know, those are the guys that will be able to go to their landlord and say, look, you know, my hands are tied here, I'm having some real cash flow issues, and I need us to take this on together, that us being landlord and tenant, and get through this period. Obviously, it's in most landlords' long-term interest to retain, to work through this period with their tenants, and retain them for the longer term, rather than you know, the worst case scenario, their business is folding just simply because they can't get through this short period where they may be having cash flow issues. So I think, you know, through COVID or really any other time when you're having these cash flow issues, you should not be afraid to approach your landlord and have these discussions about some kind of rent relief or some kind of managed solution. Now, I will caveat that your landlord will probably, like I said, this will be a partnership approach, rather than, you know, the worst thing you can do really is going in there and making demands, because ultimately the landlord has a right to receive rents. So, you know, open book and come from a place of honesty, and try to work with your landlord on a type of solution, you know, once we're going back to the new normal, if you would, to make your landlord whole again. So whether that be, you know, maybe using your security deposit in the interim to cover rent, and then topping up your security deposit at a later date, or, you know, for a month or 2 that you're not paying rent, basically increasing your rent for the remainder of the period, or some kind of managed solution to make the landlord whole again, and come up with a win-win solution where you can manage your interim cash flow, and the landlord at the end is no worse off. So obviously that's in everyone's best interest. The second kind of bucket that I've identified there is, you know, most markets in the world, I'm talking about office markets and those in the commercial world, will see some kind of reduction in rates. This is ultimately inevitable as we go through likely the biggest recession that we've seen since the global financial crisis, or arguably bigger. So, you know, those opportunities will be there for everybody, you know, whether you're having cash flow issues or not. Obviously, you need to have a lease event within your, say, office lease, you know, where you're approaching the expiry date. And through those negotiations, as the markets go down, obviously you'll be entitled to, where the lease allows for it, to be paying fair market rents. And you want to make sure that you capitalize on that, monitor the market, try and time your negotiations such that you're having those discussions at the appropriate time. And then, of course, the third one, and this is one that's very important here in Singapore, is any kind of initiatives that the government has put forward to protect tenants as they go through this period. You know, here in Singapore, there's the government stepped up in different to many governments and provided some kind of rent relief, first into landlords in the form of a property tax discount, with the express understanding that they pass on the savings to tenants. So all tenants here in Singapore will receive some kind of support through this period. So those are the sort of three broad buckets that any kind of discount or direct code driven opportunities are available to tenants in the short term.
Yeah, I mean, it's quite interesting. I mean, what I found, Steph, was, you know, we approached landlords quite early on when this whole thing started to take place, and there was this lag where landlords sort of kicked back immediately, and then sort of as it became more clear, they started to become more open to suggestion around these initiatives. And I think the government putting their initiatives in place obviously did help that as well. In South Africa, we followed old Pablo Fatidis. I don't know if anyone follows them here, but there was a huge drive on how to cut costs, and one of those areas was, you know, mechanisms that you could put into place for rent relief, and go to your landlord with a massive spreadsheet and try and get him to, you know, look at the numbers and sort of sell him onto the fact that you'll pay him over a period of time. But it's quite interesting to, you know, understand these different buckets and sort of understand which one you fall into. I think for us it was, you know, that cash flow continuity one.
That's quite right, Nigel. You know, landlords will obviously dig their heels in a big way as soon as they're provided to, you know, to you. Next thing, you and every other tenant comes knocking. So they will dig their heels in. But like I said, you know, if it's a question of either losing you as a tenant, i.e. losing your business altogether, or finding a managed, they'll always go for the managed solution to try.
I loved your statement at the top of this slide. I mean, I think it made so much sense, you know, because everyone is running around trying to, you know, figure out what to do. And at the end of the day, it was the right thing to do, which was the right thing to do. And I think, you know, we found that we just had to say, yeah, all right, we're not going to kill it. We're not going to leave you. Let's work together to see through the process.
Yeah, quite right. And then as you sort of click over to this slide here, Nigel, I just want to look. I know that not everybody on the call is based in Singapore, but many of those on the call are. So I'll just take a brief look and explain what the government's tried to provide here in Singapore, or has provided here in Singapore. So again, the emphasis, and they talk about the spirit of this kind of Temporary Measures Act that they've passed, is for landlords and tenants to have an open commercial discussion. We'll work through this together in the first instance. What they've done for all tenants, there's kind of 2 points to this, the property tax relief, and then also the Temporary Measures Act. I'll talk about both very briefly. The first is the government has announced for office landlords a 30% reduction in their property tax assessment this year. And initially, they encouraged landlords to pass this on to tenants. They've now turned around and said, actually, no, you have to pass this on to tenants. So ultimately, what that means is almost it'll be plus minus the equivalent of 3% of their annual rent roll. So it may not be 3% of your annual rent, because you may be paying more or less than the average in your building. But broadly speaking, you should be entitled to a plus minus 3% discount of your annual rent, which, you know, if you times it by 12, 36% of 1 month's rent. Now, how the landlord actually passes that on is a little bit open to discretion, but most of them will get their assessment done, property tax assessment done in May, and then pass on the reduction to those taxes through rent discounts through June and July, maybe in 2 equal installments of 1.5 months annual rent each. And then the Temporary Measures Act really restricts landlords from kicking out tenants who can't pay their rent as a direct result of the impacts of COVID-19. So it will protect your tenancy through this difficult period. Any leases that were signed before the 25th of March, is really when this thing started in Singapore, qualify for this. And like I said, it protects your tenancy through this period for about a 6 month period if you can't pay rent. There's a couple of steps you have to follow here. The first one is, again, they encourage you to have a discussion, with your landlord, open book, try and find a solution here without really evoking the act. The second one is, if a managed solution can't be found, there's a form you can download, and you have to go through this process to qualify. There's a form you can download, fill out the form, submit it to your landlord. Your landlord may then turn around and say, okay, actually, fine, don't pay rent for these couple of months, or here's the solution we'll work towards. If you still can't find a solution at that point, the assessor will step in and determine whether your revenue has been so-called materially affected by COVID-19, and you qualify for these issues, for these opportunities within the temporary measures.
Fantastic. I think, Jason, back to you, back to investment. With everything tanking at the moment, there is an opportunity for individuals to look at real estate as an option. How does one find these opportunities in this investment vehicle? And I suppose my question would be around, how does one, create value in investing in real estate?
Thanks. Nigel, I think, given what Stef has said there with regards to, some rental non-payments taking place, typically what you hear from that is that there's potentially going to be some distress in the real estate sector, and I think everyone's looking left and right to see, where the next opportunity is. And given what's happened with GFC, there were a lot of opportunities that came through. But I think this looking at the current COVID situation and reflecting back on GFC, I think the talk is that the situation is slightly different. There's a lot more liquidity in the market right now. We've seen that banks haven't lent as much against property owners or generally in the market. So there's a lot more robustness and liquidity in the market right now. So, whether there's going to be distressed assets and real estate assets falling over, it's probably a little bit too soon to say. In the next few months, we'll see exactly what sort of corporate defaults are going to be and what the results and the income that companies are achieving, and what impact that will then have on their rental payments. So probably a little bit too soon. Plus, also government and fiscal stimulus. Government is, it's a lot more than what it was in GFC. So I think we're in a better position now to take on a recession. And I think value, the opportunities will present themselves. There will be some assets that will fall over. But I think ultimately, before even doing that, I think you need to understand what are your needs as an investor. Are you owning it directly? Are you letting it out? Do you have to, are you going to have tenants? What is your stomach and risk appetite for a specific asset class? And you need to do proper due diligence and research. And I think that's even more important nowadays, in the situation. You need to make sure that you got the right partner on the ground, and through your proper due diligence, obviously location comes up, and that is the number one thing that pops to mind when people buy a property. But I think another aspect, and it's something that our company uses as an acronym there, it's called the PI effect. So before making a decision on where you're going to be going and investing, whether you're buying an apartment or you're a REIT and you're buying a portfolio of properties, you're looking at the economy, you're looking at the population, and you're looking at infrastructure. You're going to invest into a market where you see that there are jobs, there are numbers, people are migrating there, whether it's for income tax reasons or whether it's for jobs, whatever retirement. You're going to be focusing on an area and considering that, and where there's a natural migration. Infrastructure, you're not going to invest in a property which is off the beaten track. You need to ensure that your property is well located to train stations, easy access to highways and airports. So infrastructure is an important aspect when deciding to invest in property. And then employment, I touched on that, jobs. If you're going to be letting out your property, You need to ensure that there's people around to rent it out to. If it's a student accommodation, is it close to a university? So, you know, those are key fundamentals that one needs to look at. And I think going forward, I think also where opportunities and where one can create value is also about the maneuverability of a building. So look at commercial now, offices. You may see some vacancies popping up because of the COVID situation, where corporates maybe not taking up as much space as they used to. So, you know, you may have these vacancies, and landlords now need to reinvent their building. So you need to look for, you know, what is the industry that is that, you know, you can occupy it with. And we're hearing that research and due diligence, life sciences, these are sectors that are going to be needing more space. So you may have commercial property owners having to maneuver their buildings and adjust for different type of tenant. You may have commercial buildings also doing renovations and moving into and converting them into residential. So there's opportunity there. So, I mean, this comes around, you go to the next slide. I mean, I think it's effectively talking about sweating the asset.
Jay, I wanted to, oh, sorry, yeah, Jay, I just wanted to comment, because I you know, when we looked at your presentation yesterday, I really was taken by that eye effect, and I thought that was really brilliant. You know, and taking my example is, I bought a property in Fourways for the South African people on the audience today, about 15 years ago. Built it in Fourways, bought really low, and population, infrastructure, and jobs. So it all moved to Fourways in South Africa, and that, you know, the Gautrain, for those of you who know that, has now moved there. So it just proves your point in that pie effect. I thought it was really relevant in terms of making that, you know, sort of property decision.
Yeah, it's a great thing to keep in your top pocket when you start looking at investing. And you know, these are strategies that property companies follow. So, you know, I think it sums it up nicely. And I think, you know, one of the other things is, obviously when you invest into property, that you know, you can either you buy something, you build it, or you fix it up. And I think I was talking about adapting and maneuvering assets, and I think this is where you can create additional value in a property by renovating it and adjusting it to the specific market. And then obviously through building it, you create value through development. You know, you're taking a raw piece of land. And I think the key component where you can create value in any environment is how you operate and manage it. How do you stabilize it, create that income stream that is going to then be, you know, what you use when you sell your property. You know, even though you can, you know, property holds its value in the bricks and mortar, as I mentioned, having an income stream, you know, creates that additional value. And then obviously then you sell it and you benefit from the profits. So. And this is a great thing about real estate, that it, you know, if you design it properly up front, you know, you can maneuver your property and adjust it according to the market fundamentals. And we'll see a lot of that, I think, happening now in the commercial, adjusting maybe to R&D, life sciences, and residential.
Awesome. Great, thanks, Jay. That was really interesting. Stef, back to you. You know, with the world returning to work at the moment, each country is mobilizing sort of different processes or systems to ensure people go back responsibly. What lessons can we take, you know, from these different countries, as well as from you in the know about how to go back to work responsibly?
Yeah, thanks, Nigel. You know, if sort of April, early April was all about, you know, should I be seeking some kind of rent relief or rent discount? The back end of April and early March was about, you know, how and when do we go back to work safely? So I've just kind of taken a screenshot here of many of you will be familiar with this WhatsApp chat group if you subscribe to the Singapore kind of update. So it's made familiar where every day they kind of send an update on the numbers and a little bit of advice. So this is to date really the only government advice that I've seen come through. You can see on the 7th of May there. as we work towards the kind of June 1 here in Singapore and back to office date. I think it's really important to know that I think, you know, it's highly unlikely that starting June 1, we're all going to be back in the office, open plan office, squeezing as efficiently as possible, and sharing meeting rooms, shaking hands in a meeting, you know, sharing coffee cups and stuff. So I think all that's highly unlikely. There's going to be some restrictions. Some of them will be government imposed, and some of them you're going to have to take into your own hands as a manager of a business. So I just thought I'd unpack, and I perhaps won't go into all of these, but just unpack very briefly this kind of government advice that they've given. You know, staggered start and end times, or staggered start and break times, I should say. A lot of that has to do with the morning commute. You know, we probably can't go back to a situation where, you know, the subway trains are slammed at, say, it's 8 o'clock or 8:30, and the same thing with the lifts going back up. So staggered start to make sure that everyone can get to work safely. Safe entry at workplaces, I think that's really talking to, you know, the app that you already see at some of the restaurants here in Singapore, or as you go and get takeaways, because you can't actually physically go to them, and scanning in, checking in and out. In China, they even can track through your cell phone as you scan these QR codes, you know, whether you've been overseas in the last 2 weeks or in the last month. So there'll be some kind of screening as you enter an office, declaration forms, temperature screening. And then I think one thing that you'll probably see as well in buildings as you enter them, there'll be, previously buildings tried to have many different entry and exit points for retail flow. I think you're only going to see in recent in China really just one entrance point and exit point where you can control the people that are entering there. So I thought it would be appropriate for us to do a quick look. You know, we're fortunate here in Singapore, and I believe in South Africa as well, where we're almost the youngest sibling in a family, and the oldest sibling, namely China, and to a lesser extent South Korea in this case, is already kind of finding their way and learning these lessons for us. And us as the youngest sibling that's a couple of weeks behind can really learn from it. So a bit of a crystal ball when you look at what work looks like at the moment in China. And like I said, it's broadly broken into, you know, it's not just about in the office, when you're in the office, but it's broadly, you know, the commute, getting to office, entering and exiting the building safely, and then also what precautions you can take in the office. So again, I won't go through all of these. You can go through it on your own time when we set up the recording. But, you know, some of the interesting things are, for instance, now in China, if you can just go back, I'll just spend a moment there, Nigel. Some of the interesting things that you can see in subway compartments, even, you know, you don't have to, but you can check in and out through a QR code into your subway compartment. That obviously helps with contact tracing, this type of thing, with the use of masks, so on and so forth. And then the building, I think the key thing here is the lift, which is a problem. We know that at peak periods, during normal times, it can get quite crowded as you're getting up to the lift. Now, obviously, if you're restricting the amount of people that can get into a lift in China at the moment, it's a maximum of 7 per lift. It can take quite a long time to get in and out of the building, and you can't have people standing in the lobby, kind of waiting very close together. So that's why the sort of staggered start. And the other thing they're doing is they've got your tissues and hand sanitizer on high-touch areas, so you can use a tissue to touch the lift button and/or wash your hands immediately after. I think the placement of hand sanitizer and this type of thing and cleaning kits is really interesting. That's something you're going to see a lot of, you know, as there's kind of an anxiety around returning to the office. Employees may feel they want to take matters into their own hands. They want to know for a fact if they're sitting at a desk or something that's been cleaned properly. So therefore, they'll take solace in the fact if they've cleaned it themselves. So having on high touch points, having these kind of cleaning kits, I think we're going to see a lot of that. And then, you know, same thing in the office, very similar to what we saw here in Singapore, really, before the circuit breaker, 1 meter spacing, restriction of shared spaces, declaration forms, temperature checks, this type of thing. And then I'll just quickly touch upon this one, Nigel, because I think it's interesting. A lot of people are kind of feeling helpless in the current environment. We sort of got just a week or two before we go back to the office. Yeah, you know, what can I do now to manage my employees? And to me, you know, the most important thing is setting up protocol and setting up task force teams that are really going to handle this on account of your company, because, you know, ultimately there will be, I think it's inevitable that as we all go back to work here, there will be cases, there will be unexpected things, you know, despite best efforts. You may find, you know, if there's a case of COVID-19 amongst your workforce that was contracted in your office, how do you react? Whose job is it to react? And what's the protocol? So I think establishing those protocols now is very important. And then also, you know, as we go back to work here, we've just been through this massive experiment, if you will, of working from home. And that really means different things to different people. If I look at myself, you know, I personally can't wait to get back to the office. I feel like my productivity has, well, I've got 2 kids under the age of 3, so.
I can tend to agree with you, Stef.
Yeah, so I think really understanding, because we won't all be allowed to go back at the same time, you know, who goes in first and who comes in at a later wave. You know, we may have somebody who is older themselves, you know, approaching retirement, may feel vulnerable going back to the office, or they're looking after elderly parents. They may not want to go back to the office. You may have others, like I said, like myself, who are absolutely dying to go back to the office and feel like the office is an important place for them to stay productive. So really, you know, understanding your workforce, who's in one situation and who needs to go back. I've kind of put a couple of different profiles here if that's interesting to anybody. But some people may feel that they don't want to or need to go back to the office. Other people may feel like they want to go back to the office, but their situation at home prevents that from happening. For instance, if you've got kids that need childcare and schools aren't open yet, you may feel that despite your best intentions, or despite your willingness to get back to the office, you simply can't do that. And then the last bucket is the likes of myself, who hopefully I'll be the first one through the door on June 1.
Yeah, it's that coffee. What's it? The coffee break discussion that I think everybody's missing. Staying at home. Thanks, Stef. I mean, there's a lot of info there, and I think we can all sort of. It's an evolving thing, like you said. Jason, sort of back to you. You know, as a real estate investment company and operator in the UK and the US, you know, which geographies and sectors are expected to outperform others? And Jay, before we do this, you know, if there's any questions from the community, guys, please just put it in the chat. As we build up to sort of the end of the webinar, just put your questions in. I'll pick a few and we'll direct them to the panelists as well. But Jason, do you want to talk us through essentially, you know, where the opportunities are?
Okay, great. So yeah, I think that's always you know, where the next hotspots, where to now, and I think maybe just fundamentally for us as a company, we focus on developed markets. We look at areas where there's political stability, where the rule of law can be enforced, a stable currency, and a liquid market, where a market we can exit and sell our properties. So I mean, these are key fundamentals that we follow, and I think, you know, depending on one's appetite and for risk, you know, these are markets that we focus on, and I think you know, something that one can also apply when they're looking at investing. If we just look here, sorry, are the slides in my control? Yeah.
Yeah, they are, mate. You should just push. Yep, there we go.
Okay, so the next slide is just where we focused on as a company has been in the UK primarily into purpose-built student accommodation, but other markets, the US, the little stars there show Florida, Texas, and it's Tennessee, which are areas that are showing population growth. There's a migration of people there, the pie effect in these specific areas. Germany, our sister company, IP Global, has done numerous investments into Germany, which is, the top economy in Europe. And there's certain markets, Berlin, Leipzig, where there's opportunities. And then Portugal, which we've seen a lot of opportunity and a lot of growth. Lisbon was voted #1 city in the world to invest in last year by PwC. Porto is also an interesting city. And I think Portugal, they've invested a lot into infrastructure the last 5 years, and this is now showing through the results in the performance of property. Just in terms of sectors, I think for us, purpose-built student accommodation, and I think this is something that this is a #1, our #1 investment class that we invest into. And why? Because it's counter-cyclical. And it's actually when unemployment goes up, student numbers rise. So purpose-built student accommodation has proven to be a defensive asset class, and one that is definitely going to be winning the race in the not too distant future. I think you may see some short-term rental income hiccups, but ultimately this is an asset class that has proven to be resilient and defensive. And this occurred after GFC, and we expect the same to happen here. When people lose jobs, they do go back to study and reinvent themselves. So they tool up and try and become more marketable. Other asset classes are multifamily in the US, and also the build-to-rent sector in the UK. Typically undersupplied markets, and these markets also recover the quickest, particularly after GFC or downturns. They are. I'm just having an issue with the slide moving here, Nigel.
Sorry. Want to move forward?
Yeah, go for it. You move it.
Okay. Right, go for it, mate.
Yeah, US multifamily, which is very defensive. After the last GFC, it recovered the quickest. The rental reduction was the least, and as much as we've seen a spike in unemployment in the US and in the UK, these sectors are typically bounce back the quickest, and this is where we focus. It's not moving, Nigel. Do you want to just flip it to the next? Yeah, so that was
Nigel.
that's
Jason,
student. Yeah.
So just a brief comment. I see you've got logistics sort of on your previous slide there as well. I know you guys are more core, and perhaps the logistics sector is more for those with a bit more of a risk appetite. But I think it's interesting, what's going on in the logistics center at the moment, as there's a lot of talk about these guys, moving from the long heralded best practice model of just in time, basically keeping as low inventory on hand as possible, to now that they're experiencing this kind of unexpected and unprecedented demand, moving to a so-called just in case model where they keep more inventory on hand. And obviously that means more space, and perhaps for somebody who's got a bit more of a risk appetite, that could be an opportunity.
Yeah, but definitely. Just the logistics is also, absolutely last mile is and the shortage of space nowadays because of the advent of last mile and online, is going to drive up values. And obviously now with the lockdown and people not getting to retail, that's supporting that sector. Healthcare also, we expect that could also be an interesting sector to invest into. We focus more on the operational residential, which is for us, a lot more defensive and resilient. you can just flip through the next couple of slides there, Nigel. Yeah, I think we're going to see probably in the residential space, there'll be a downturn in rentals. But again, already, yeah, this graphic, how they expect it to spike again in the early quarters of next year. Next slide there, Nigel. Just I think this, yeah, I spoke to this here, how you saw that the rent decline from the last recession was at least in multifamily or residential in the US, and it recovered the quickest, and it was still growing pre-COVID. You'll see a little dip, but we expect that rents will recover. You know, already Germany, you've seen that how they're anticipating their market to come back middle of next year. So if you can move to the next slide. Yeah, no, I've spoken through that, so that's good. I mean, we can also share these slides with everyone afterwards, so they can. Yeah, so I think just to sum up before Stef just takes the next question is, you know, PBSA, purpose-built student accommodation, UK particularly, is definitely a shining light. Even though we may see a hiccup in the short term, typically it's the one that a lot of institutions are hungry for. It provides that stable income and that capital protection. Cool.
Thanks, Jace. Sorry about the control. Maybe getting too technical too soon. Anyway, thanks, Jay. Stef, onto what I'm sure is probably an opportunity for a lot of sort of commercial companies such as myself. What is the outlook in terms of rental prices, you know, or opportunities around stock or availability in the market?
Nigel, thanks. I'll really tackle that question, I suppose, mostly from a commercial real estate point of view, particularly office space. And, you know, I think it's very easy to assume that, you know, rents will come crashing down in the next couple of months or next couple of 18-month period. And that's not a view that I disagree with necessarily, but it is worth noting that there are sort of push and pull factors. You know, for a lot of this, the market weakening factors I won't talk too much about, because I think everybody really understands that. You know, as we work from more and more people may feel they can work from home now, you know, and therefore companies may feel they need less and less office space. And obviously that has an effect on supply-demand economics, and rentals will come down as a result. Some businesses may fold, and therefore there may be broadly less demand for office space. But on the other side of that equation, there's also some market strengthening influences. You have to remember that all construction at the moment really around many parts of the world have stopped. And obviously that may create a bottleneck effect for future supply to come on, and ultimately, you know, push rentals up in a way. One of the points that's not on there, but there's a lot of speculation at the moment around people perhaps diversifying their exposure to China or any one market, really, because you never know when the next COVID-19 or similar event happens, and moving some of those facilities or some of those resources to say Singapore. So you may see all of a sudden an increase in demand here actually as people look to move out of China. But broadly, I did want to answer your question. We know that real estate and rentals are a bit lumpier in nature, a bit more illiquid than, say, the equities markets, you know, primarily because people are on longer lease terms, and you know, some people may have step-ups in their rent and escalations built into their rent. So over the next 18 months, they may even be experiencing an increase in their rental levels because that's what their lease states, rather than a decrease in line with market. So we do see these kind of market reactions come a little bit delayed to the actual event when compared to, like I said, the equity markets. But that said, you know, 2020, we're expecting a period of uncertainty. Like I said, I think landlords are really digging their heels in. But, you know, I think already we're seeing, you know, in say Hong Kong, mind you, Hong Kong starting from the world's very high base as the world's most expensive office market, and also got a bit of a head start with some social unrest and geopolitical factors happening in Hong Kong. But we're already seeing 5 to 10% reduction in rental there. I see WeWork has given up, not to name any but has given up 180,000 square foot of space there really overnight. So that will immediately have an impact on the office markets. Many people are calling for a 33% reduction or so in rental levels over the next 18 months in Hong Kong. And I think here in Singapore, you're also going to see some kind of decline into 2020, and then especially in 2021, when some of these guys see their leases come up, and they'll consider their position on what they're going to do in terms of working from home. More people are going to work from home, or perhaps they've lost some headcount and want to do something else.
Stef, I suppose it's a typical supply and demand scenario, right?
Yeah, exactly. That's right. So, we think that guys who have got those 2022 expiry dates and they're negotiating their leases in 2021, that's probably the sweet spot for any kind of market-driven rent reductions. Again, I'm speculating. I'm using my own little crystal ball here, but that seems to be where the sweet spot's going to sit. We already know from those surveys and that we've done with providers in the flexible office space, because those guys are on shorter lease periods and they roll over quite quickly. We already know that in the month of April, 27% or so of tenants haven't renewed their leases.
Yeah.
These are typically smaller businesses, so they may be more vulnerable in times like these, but it is a sign of things to come. Activity levels there in that market, in that sector, are about 20% of what they typically are.
Cool.
So that gives a view of what we may expect at the back end of 2020 and 2021 for conventional office space such. And then 2022, who knows, maybe work from home becomes the new norm, and everybody starts working from home. I have seen a lot of sensationalist reports sort of calling the death of the office, but that's not a view that I share, and I do expect markets to start returning along with the economy and speculatively in 2022.
Cool. I mean, I think I saw an article around, one of the challenges on not having an office or place to go is how do you onboard a new staff member, right? It becomes extremely difficult. So I think there's arguments against both the future of no office and the future of from home. Anyway, there's a great question here, which I think is relevant to the investment side. Given the amount of SAFers on the call, that's how it starts. I have a few related questions. So the Rand is depressed at the moment. There's some great residential and commercial buying opportunities in South Africa. This raises two questions. One, the Rand could continue to fall. How can buyers best mitigate this long-term currency impact? And what would you recommend we do to finance a purchase in South Africa? Is it best to finance it on or offshore?
So looking to buy a property, living abroad and buying into South Africa.
Yeah, maybe get better value.
Well, absolutely. I mean, look at what the currency's done. So, if you're buying in Sing dollars and you're buying a property in Rand, it's a significant discount. I think it's 13-1 at the moment. With the Sing dollar being pegged against the US dollar, what's it at 18.5 now to the US, the Rand. So yeah. I think there's been talk that maybe the new US dollar, the mean is going to be 16.50. So whether the dust settles and South Africa, I think the US dollar is not going to. It's still going to be. It's not going to weaken much, but I think that the Rand, hopefully, it comes back a bit, and then stable, hovers around the 16.5 to 17. It all depends on what happens politically. But I think investing into South Africa, whether you're South African or not, I think you got to understand what are your needs. What are you investing in South Africa for? Do you want to rent it out? Do you want to retire there? If you're retiring there, then does it really matter what sort of capital appreciation you achieve and what the property market does in South Africa, because you're going to ultimately retire there. But if you're renting in there for investment purposes and you're going to find a tenant, I suppose your yield will be a bit higher, but again, it comes down to knowing where you're going to invest. Have you got the right partner on the ground? Do your research, your due diligence. Follow the pie effect, and I'm sure there'll be opportunities.
Yeah.
Do
they finance that? Sorry, Jay. The question.
How do you
The
finance
last
it?
question was: do you finance it here or do you finance it there? Well,
I think just try and finance it in the currency that the asset is in. That's always the prudent advice, But I mean, again, do you want to be exposing yourself to rand? So if you can raise a loan out of Singapore, from a Singapore bank or a Hong Kong bank, I suppose then, what appetite does a foreign bank have for South African property? Or are they going to just are you just going to take a personal loan and use that loan then against your own balance sheet, not use the property as a mortgage? So, there's different ways to look at it. But the prudent advice is always to invest in the currency that the asset is in.
Cool.
Because if you're going to hedge and you put a hedge on that currency, then you're paying for that.
Good. All right, cool. We've got a whole lot of questions, but we're running out of time. So thanks, guys, both for your valuable insights. I do think, it gives our community a lot to think about and a lot to, maybe there are quite a few questions here in the list, which we will shoot over to you guys, and hopefully you can engage directly with the people that are asking the questions. In closing, I would want to ask each of you just for some key takeaways on the presentation. Some points to ponder on. Jason, perhaps you can start and sum up your side, and then we'll move on to Stef.
Yeah, just a quick 1 minute. I think don't be lulled into inaction in the current environment. Look for those opportunities. Do your due diligences and your research, and you're bound to find some gems. And consider alternative asset classes like student accommodation, which are very defensive. And they can create a balanced portfolio. I think the next slide, I think there's a few takeaways there, Nigel, which I think, defensive asset classes, now's the time to look at something that is going to, hold value and provide you with stable income. So that's it from me. Thank you for the opportunity.
Yeah, thanks, Stef. Some takeaways from your side?
Yeah, thanks, Nigel. I see it's just gone 6 o'clock here in Singapore, so I won't spend very much time here. But if you could help me just kind of pull up that slide. I think the first one there is for tenants that do find themselves in a bit of if you're an occupier of primarily office space or really any commercial space, that finds yourself in need of a solution. Don't be afraid to reach out to your landlord and try and find a managed solution. Don't leave yourself in a situation. Try to control that situation. Like most landlords are looking to find a win-win partnership and work with you your way out of this. So don't be afraid to approach them and work that. I think if you're in charge of managing your safety or the safety of your employees, going back to the office here, expect the unexpected. We know from China, we know from Korea, we know from many other places that we are likely there will likely be cases of unexpected contractions of COVID-19 as people go back to the office here despite best efforts. So how do you react, right? Have a plan in place for that. For those that are looking to sign longer-term tenancy agreements or may find themselves, may feel like they don't have an option other than to commit to this 5-year lease or 10-year lease, there are alternatives out here, whether that's in flexible office space or whether you work with your own landlord to say, look, I can't commit. I don't know where my business is going to be because of what's happening in the world. I don't know where my business is going to be tomorrow, never mind in 5 years or 10 years' time. Try and work on some kind of increased flexibility within your lease or find a managed solution for the interim until you have a better understanding of the trajectory your own business is in. And then the last one there, there's a lot of debate around what the office space of the future will look like. Like I mentioned, I don't think this is the end of office space, but I do think that office space will need to evolve and adapt. And I think, it will become an alternative place to work along with home, along with the coffee shop and so on and so forth. So it needs to provide more than just a desk. It needs to provide, opportunities for collaboration, opportunities for quiet work, which you may not have at home, or the coffee shop, or this type of thing. But really the message is to understand, what your employees need from their office space, and then try and provide that.
Thanks, guys, and to all of you on the call today, thanks so much for your time, from the Chamber of Commerce in Singapore, to all our South African people back home, and to our broader audience online today. Thanks for joining us. I think there was some great insights here. We've got a few more content-driven webinars coming up soon, so keep your eyes posted. We've got some a nice social one planned up soon. So thank you, everybody. We'll be putting this on social media, as well as sending you an update following for Stef and Jason to get in touch with you. Thank you very much, and have a good afternoon, everybody.
Thanks a lot, guys.
Cheers, guys.